Welcome back, ladies and gentlemen. The gold market is reeling from one of its most violent single-day corrections in history, erasing nearly $600 of gains almost overnight, as President Trump officially taps Kevin Warsh for the Federal Reserve chairmanship. While the mainstream headlines are focusing on the nomination itself, the smart money is already reacting to a deeper signal about the future of the US dollar that most retail investors are missing. If you want to understand why the fear trade just hit a brick wall and what this means for your portfolio, you need to watch this analysis. This content is for informational and educational purposes only and should not be considered financial advice. To understand the violence of this correction, we must first dissect the anatomy of the parabolic rally that preceded it. Just 48 hours ago, the precious metals complex was in the midst of a historic melt-up, with spot gold piercing the $5,600 level, a price point that fundamentally repriced the market as expectation of currency debasement. This surge was not driven by standard retail speculation, but by a systemic institutional bid front-running the Federal Reserve's leadership transition. Smart money was aggressively hedging against the potential for policy chaos, effectively pricing in a scenario where central bank credibility might fracture under political pressure. However, markets are efficient at punishing crowded trades, and the reaction to the Kevin Warsh nomination was immediate and severe. The confirmation of a known hawk instantly evaporated the uncertainty premium that had been supporting these elevated valuations. We did not merely see a pullback, we witnessed a liquidation event where the price collapsed through the psychological support of $5,000, erasing nearly a week of vertical gains in a single session. This $600 drawdown signals that the market is rapidly unwinding the fear trade, forced to accept that the Federal Reserve may remain far more disciplined and restrictive than the bulls had anticipated. The specific catalyst for this liquidation event arrived just 24 hours ago, when President Trump officially nominated former Fed Governor Kevin Warsh to replace Jerome Powell. While the mainstream headlines are fixating on the political implications of a Trump loyalist taking the helm, the bond and precious metals markets are reacting to a far more nuanced reality, the sudden removal of the uncertainty premium. For weeks, the gold market had been pricing in a worst-case scenario, essentially a burn it down candidate who might completely politicize the central bank or abandon the dual mandate entirely. This fear forced institutional capital to bid up gold as a catastrophic insurance policy against a total collapse of Federal Reserve credibility. Markets despise a vacuum, and until yesterday, the void of leadership created a massive speculative bubble in safety assets. However, Kevin Warsh is a known quantity to Wall Street. Having served on the board of governors during the 2008 crisis, he represents institutional competence rather than chaos. The instant his name was confirmed, the catastrophe trade unwound because the market realized the Federal Reserve, while likely to be more dovish under Trump, will not be dismantled. The $600 drop in gold is not necessarily a reflection of gold's long-term value, but rather the sound of that specific risk premium hissing out of the market. Investors who are paying for protection against the unknown are now frantically offloading that insurance, realizing that while Warsh may be a reformer, he is not an arsonist. This volatility crush is the primary mechanic driving prices lower right now. The market is simply exhaling. To fully grasp why the market is aggressively repricing the precious metals sector, we must look past the immediate volatility and examine the monetary philosophy of the man now poised to lead the Federal Reserve. Kevin Warsh is not a blank slate to Wall Street. He carries the distinct historical reputation of a monetary hawk, a label earned during his tenure on the Board of Governors in the aftermath of the 2008 financial crisis. Unlike the consensus of modern central bankers who view quantitative easing as a permanent tool in the policy arsenal, Warsh was historically a vocal critic of open-ended asset purchases. During the early rounds of QE, he warned that excessive liquidity would eventually distort capital allocation and invite instability, distinguishing himself as an advocate for sound money. Principles that prioritize long-term currency stability over short-term market stimulus. This reputation creates a direct structural headwind for the gold market. Fundamentally, gold functions as a hedge against currency debasement and the perceived loss of central bank control. It thrives in an environment of negative real rates where the cost of holding a non-yielding asset is negligible compared to the erosion of cash. However, a Federal Reserve chair who is perceived as disciplined, someone willing to defend the purchasing power of the dollar even at the cost of asset prices, undermines the core thesis for holding precious metals. The signal the market is receiving is unambiguous. If the Fed returns to a regime of positive real interest rates and balance sheet restraint, the dollar regains its utility as a store of value. When the currency is managed by a hawk, the opportunity cost of holding gold, which pays no dividends, offers no coupon, and incurs storage fees, rises dramatically. Institutional allocators are effectively betting that under Warsh, the era of easy money and automatic liquidity injections is drawing to a close. This shift in perception forces a repricing of the entire metals complex, as the urgency to flee the fiat system diminishes when the central bank signals a renewed commitment to defending the currency. The immediate verdict on the Warsh nomination was delivered not on the COMEX, but in the foreign exchange markets, where the US dollar index executed a violent structural breakout. Within moments of the announcement, the DXY spiked aggressively, reclaiming levels that technical analysts had previously written off as resistance, effectively wrecking the short dollar consensus that had built up over the prior quarter. This is not merely a daily fluctuation, it is a profound repricing of the global reserve currency's expected yield and stability. When the market sees a figure like Warsh, who is philosophically aligned with defending the currency's purchasing power, capital floods back into the greenback, seeking the safety of a managed, positive real yield. This resurgence of the dollar acts as a mechanical gravity on the price of gold, functioning through the brutal efficiency of the inverse correlation. Because gold is priced in dollars on the international stage, the math is unforgiving. When the denominator of that pair, the dollar, strengthens rapidly, the nominal price of the asset must adjust downward to maintain equilibrium. This is the denominator effect in real time. For an algorithm, the calculation is instantaneous, but for the physical market, the impact is even more severe. Consider the perspective of the foreign buyer, the sovereign wealth funds in Asia, or the central banks in emerging markets that have been the primary drivers of gold's structural demand. When the dollar rips higher, gold becomes exponentially more expensive in their local currencies, whether that is the yuan, the yen, or the rupee. Their purchasing power is effectively squeezed from two sides, the raw price of the metal and the exchange rate to acquire the dollars needed to settle the trade. This double-edged sword instantly evaporates the physical bid from the market. We saw this liquidity vacuum form immediately yesterday. As the dollar spiked, foreign buyers stepped away from the table, removing the floor that had been supporting prices and allowing the paper market to flush lower without resistance. What we witnessed in the last 24 hours is a textbook execution of the oldest dynamic in speculative finance. Buy the rumor, sell the news, but played out on a sovereign scale with unprecedented violence. To understand the mechanics of a $600 crash, you have to recognize that the price action leading up to this moment was built almost entirely on the anticipation of disruption. For weeks, managed money and macro funds were aggressively accumulating long positions, not necessarily because they believed gold was fundamentally undervalued at $5,600, but because they were pricing in the volatility of the unknown. The market was positioning itself for a chaos candidate, an appointment that would signal a complete departure from orthodox monetary policy, potentially someone who would weaponize the Federal Reserve's balance sheet to fund fiscal expansion without restraint. However, the confirmation of Kevin Warsh acted as a psychological circuit breaker. Warsh is many things, but he is not an agent of chaos. He is a creature of the financial establishment, a former governor with deep ties to the plumbing of Wall Street. When the announcement hit the wires, the catastrophe premium that had been priced into every ounce of gold instantly evaporated. The market realized that the worst-case scenario, a complete unmooring of the dollar, was off the table. This triggered a mechanical and merciless unwinding of positions. Professional traders, who were sitting on weeks of vertical gains, did not wait to debate the long-term nuances of Warsh's policy leanings. They hit the bid. This mass exit created a liquidity vacuum. In a crowded trade, the door is never wide enough for everyone to leave at once. As the first wave of institutional profit-taking hit the order book, it overwhelmed the buying interest, which was already thinning out due to the strengthening dollar. What followed was a cascade of long liquidations. When professional capital decides to book profits on a parabolic move, they do not scale out gently, they flatten the book. This collective rush to lock in gains exacerbated the speed of the decline, turning a healthy correction into a $600 rout. The violence of the move down was simply the mirror image of the speculative froth that had built up on the way up, proving once again that in parabolic markets, the elevator down is always faster than the stairs up. To comprehend the speed at which capital has rotated out of the precious metals complex, one must analyze the specific signal the Warsh nomination sends regarding the institutional integrity of the Federal Reserve. For months, the smart money had been hedging against a genuine tail risk, the possibility that the administration would appoint a purely political operative to the chairmanship, someone explicitly tasked with dismantling the central bank's independence to facilitate unrestricted fiscal dominance. This scenario, often referred to in macro circles as the end of the independent Fed, was a primary engine driving gold's vertical ascent. Investors were not just buying metal, they were buying insurance against the potential collapse of institutional credibility. The confirmation of Kevin Warsh, however, effectively neuters this catastrophic narrative. While he is undoubtedly the president's choice, Warsh is not an outsider seeking to burn down the building. He is a creature of the establishment, a Wall Street veteran with a deep pedigree at Morgan Stanley, and crucially, a former governor of the Federal Reserve System who served from 2006 to 2011. He sat on the Federal Open Market Committee during the crucible of the global financial crisis, navigating the plumbing of the banking system alongside Ben Bernanke. To the bond market and institutional allocators, his resume reads as a signal of continuity rather than destruction. It suggests that while the Fed may pivot in policy direction, the underlying machinery and the guardrails of the monetary system remain intact. This restoration of perceived stability is lethal to the safety trade. When the market realizes that the central bank will not lose its operational independence or its status as a credible counterparty, the desperate need to hoard gold as a hedge against systemic failure diminishes rapidly. The premium that investors were paying for protection against a rogue Federal Reserve has been repriced to zero overnight. Institutional funds that had allocated billions into gold as a distinct hedge against a loss of trust event are now unwinding those positions, not because they believe inflation is conquered, but because the specific threat of institutional anarchy has been removed. The market has effectively concluded that under Warsh, the dollar may fluctuate, but it will not be abandoned. Consequently, the capital that fled into hard assets for safety is now flowing back into traditional financial instruments, comfortable once again with the risk profile of the fiat system, managed by a known and competent insider. If gold's correction was a warning shot, the action in the silver market was a massacre. While gold traders are nursing a 10% drawdown, the silver market witnessed a historic implosion, collapsing by nearly 30% in a single trading session. This is not normal market behavior. It is a liquidation event of biblical proportions. Silver, often functioning as a high beta-leveraged play on gold, effectively gave up months of gains in hours, plummeting from record highs above $120 down to the mid-80s. This level of violence highlights the danger of the poor man's gold narrative. When the exit doors close in a niche market, the stampede crushes everyone standing in the doorway. The damage wasn't contained to the physical metals. The mining sector was dragged into the abyss as well. The major mining ETFs, which had already been lagging the spot price during the rally, a classic bearish divergence warning sign, capitulated. Investors who sought leverage through miners found themselves trapped in a double whammy of falling margins due to lower metal prices and a general equity market sell-off that punished risk assets. The miners, which are capital-intensive businesses, are now being repriced not just on lower revenue projections, but on the fear that the easy money era that funds their exploration is over. The mechanism driving this sector-wide bloodbath is a textbook liquidity cascade triggered by margin calls. When a highly leveraged asset like silver drops 20% in a morning, it triggers automatic maintenance margin breaches for thousands of speculative accounts. Brokerages do not ask for more cash. They simply liquidate positions at market price to cover the shortfall. Crucially, when traders are bleeding out in silver, they often have to sell their winning positions, like gold or mining stocks, to raise cash to cover the hole. This creates a vicious feedback loop where selling begets more selling, regardless of the fundamental value of the asset. What we saw yesterday was the get me out at any price phase of the cycle, where correlation goes to 1 and liquidity evaporates completely. This flush out, while painful, is often the necessary process to scrub the excessive leverage from the system, leaving the market in stronger hands, but only after the weak hands have been completely washed out. However, before we accept the hawkish restoration narrative as gospel, we must examine the critical nuance that the algorithms and headline-reading bots may be missing. There is a distinct possibility that the market is mispricing Kevin Warsh. While his reputation is built on his dissent against easy money in 2010, his more recent rhetoric suggests a significant pivot. In the months leading up to this nomination, Warsh has increasingly aligned himself with the administration's pro-growth agenda, arguing that the Federal Reserve has been too restrictive. He has publicly suggested that an AI-driven productivity boom could allow the economy to run hotter without igniting inflation, a supply-side argument that effectively creates intellectual cover for lowering interest rates. This introduces a massive asymmetrical risk to the current market pricing. Right now, traders are dumping gold because they expect Warsh to be a Volcker-light figure who will defend the dollar at all costs. But what if he is actually a supply-side dove? If Warsh takes the helm and immediately moves to cut rates to support the Treasury bias refinancing needs, justifying it with productivity optimism, the dollar's rally could brutally reverse. In this scenario, the current $600 crash in gold would not be the end of the bull market, but a massive bear trap, a liquidity flush that shakes out the weak hands right before the central bank validates the very inflation fears investors just stopped hedging against. The danger for the bears here is that they are pricing in the Warsh of 2010, not the Warsh of 2026. To assess the damage from a structural perspective, we have to turn to the charts and strip away the emotion. The drop we just witnessed is visually terrifying. A vertical red candle erasing $600 in roughly 24 hours. In the short term, the technical damage is undeniable. The price has sliced through the immediate psychological floor of $5,000, a level that many late-arriving retail bulls were treating as an unbreakable fortress. By closing below this key pivot, the market has confirmed a failed breakout pattern, which typically invites further testing of lower levels as frustrated longs capitulate. However, when we zoom out to the weekly or monthly timeframes, the narrative changes from catastrophe to consolidation. Despite this violent correction, gold is still up nearly 90% year over year. We are currently testing secondary support zones around the $4,800 level, regions that were considered blue sky resistance just months ago. This suggests that while the parabolic fever has broken, the secular trend remains intact. A correction of 10 to 15% is historically standard behavior during the early stages of a massive repricing event. As long as the price holds above the major structural breakout zone of $4,500, technical analysts would classify this not as a crash, but as a backtest of the breakout. A necessary, albeit painful, mechanism to transfer assets from weak speculative hands to long-term institutional holders. Beyond the immediate noise of the derivatives market and the knee-jerk reactions of high-frequency trading algorithms, there remains a structural reality that the paper market cannot simply wish away: the relentless, price-agnostic demand from the official sector. While speculative capital flees the futures market in response to the Warsh nomination, the physical floor of the gold market is being poured by central banks, specifically those in the global south and the east, who are engaged in a multi-year strategic pivot away from the US dollar. For sovereign buyers like the People's Bank of China, the Central Bank of Russia, and increasingly nations across the BRICS Plus alliance, the price of gold is secondary to its utility as a geopolitical shield. They are not trading the Fed OAS.plot or reacting to the personality of a new chairman. They are accumulating an apolitical reserve asset to insulate their economies from the weaponization of the Western financial system. This $600 correction, while devastating to leveraged retail traders, is viewed entirely differently in the halls of sovereign wealth funds. For the past several months, as gold prices went parabolic, official sector buying had likely paused or slowed, deterred by the extreme premium required to acquire tons of physical metal. Central bankers are, by nature, conservative value buyers. They do not chase vertical charts. However, a drawdown of this magnitude effectively reopens the acquisition window for nations that were previously priced out. We are likely witnessing the activation of a massive sovereign put option beneath the market. When the price crashes due to paper liquidation in New York and London, it transfers physical inventory into the vaults of Shanghai, Mumbai, and Ankara at a discount. The narrative that a hawkish Fed chair solves the U.S. fiscal situation is unconvincing to these strategic buyers. They understand that even with Kevin Warsh at the helm, the structural drivers of U.S. debt issuance and the geopolitical fragmentation of the global economy remain unchanged. A stronger dollar in the short term does not erase the $35 trillion in U.S. debt, nor does it reverse the trend of sanction-proofing reserves. Therefore, this pullback is not a signal for foreign central banks to stop buying. Historically, it is precisely these moments of liquidity-driven capitulation that allow large sovereign actors to step in and absorb supply without pushing the price against themselves. While the fear trade has evaporated for Western hedge funds, the sovereign accumulation trade has just been gifted a significantly more attractive entry point, potentially creating a hard floor for prices that technical analysis alone might miss. The transfer of wealth is currently flowing from impatient Western paper hands to patient Eastern physical vaults, a dynamic that often marks the bottom of a correction rather than the beginning of a collapse. The nomination of Kevin Warsh marks more than just a personnel change. It signals a potential regime shift in how the market values the reserve currency. The violence of this correction was the market's brutal but efficient mechanism for acknowledging that the weak dollar thesis is no longer the default setting. By flushing out the speculative froth that had accumulated above $5,000, the market has reset its baseline, forcing investors to grapple with the reality of a Federal Reserve chair who may prioritize currency stability over asset price inflation. The easy money trade has been paused, and the burden of proof has shifted back to the gold bulls to justify valuations in a potentially higher rate environment. However, do not mistake this repricing for a conclusion. The volatility is not over, it has merely changed shape. We are now entering a critical period of price discovery, where the market must navigate the upcoming confirmation hearings. This is where the difference between Warsh's hawkish historical reputation and the political demands of the administration will be laid bare. The smart money will be scrutinizing every statement to see if he walks the walk of a disciplinarian or if he signals a pivot under pressure. As we track this transition, the most dangerous thing an investor can do is assume the story is finished. If you want to understand the mechanics of this new Fed era as it unfolds, make sure you are subscribed for the next update. Do you think the market is right to trust Warsh to protect the dollar, or is this the perfect entry point for gold? Let me know your thoughts in the comments below.